Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia and managed by our company LifeChamp. Our webinar title today is Retire Early or Retire Late. Which one suits you? My name is Shen Chu. I'm the moderator for this session. So in this webinar, we're going to explore different retirement schemes available in Malaysia, and we're going to talk about different retirement strategies. So should we retire early or should we opt for retire late? So this is a discussion that will take place today. Now, before we begin, disclaimer, whatever we share in this webinar is only for educational purpose. In no way that I give any recommendation for the buy or sell any listed securities that we mentioned here. If you decide to make any investment decision, you're solely responsible for all your investment risk. Now, allow me to briefly introduce our speaker today. He is a licensed financial planner with Philip Wealth Planners Neighborhood. He may also advise on equities, debentures, or warrants listed on Bursa Securities. He holds a Bachelor of Laws from International Islamic University, Malaysia, and a professional certificate of Islamic financial planner from Islamic Banking and Finance Institute Malaysia and Financial Planning Association of Malaysia in 2005 and 2011, respectively. So currently, he acts as a Bursa Marketplace social media influencer. He is the author of a book, Rancang Wang dari Sekarang, and now writes newsletter via Pakdi.substack.com. His experience in financial sector started in 2004 as a unit trust consultant prior to working with Bank Islam Malaysia as a Sharia product researcher. Currently, he specializes in investment advisory to affluent and high net worth individuals. So he's none other than Pakdi. All right, Pakdi, how are you today?
Fine, thank you. Thank you, Shane, for inviting me tonight.
Yep, good to speak to you after so many years. Okay, so this so the stage is yours. We can't wait to learn from you about retirement planning. So over to you.
Okay, thank you, Shane. Okay, Assalamualaikum and very good evening. I would like to find my slide first. Okay, this is my slide. Sorry. I'm sorry.
Yes, perfect.
Okay. Okay. So I would like to start my session today by asking participants today on, you can write in the chat box, okay, how much do you think you need monthly post-retirement? Okay, that's the first question. And to achieve that, how much savings do you need to get your monthly cash flow post-retirement? So there are two elements there, your monthly or annual cash flow and also the savings that you needed for retirement purposes. Okay, so you can put some any numbers that you think appropriate or suitable with your situation. How much do you need monthly? And for example, PK Lim here stated that he needs to 20,000. However, how much the capital that you need in order to generate 20,000 per month? Okay, there are two elements. Yeah, how much do you need monthly, and also how much capital you need to generate that income. Okay, so Sufyan, 49K, I'm not sure 49K is annual or monthly. 15K, maybe monthly, 15,000 per month. Joshua here, 5,000 per month with 10 million in capital. And Liza here, 5,000 per month with 2 million in capital. Ju A, okay. 6,000 monthly, 2.5 million. Okay, 10,000. Okay, Zulhairi Zulkifli, 5,000 per month with capital of 1.5 million. Okay, Kensu, 15,000 per month with 3 million. And Sengho, 1 million. Atika Huda, 5,000 with 1.5 million. Okay, thank you for all who give a response to my question. Okay, so there's two things that you need to remember when we discuss about retirement. There is first you must know how much do you need every month or annually post-retirement, and in order to achieve that numbers, how much savings that you need to accumulate during your working days. Okay. So in my session today, basically we will discuss on two things. Okay, first is about the traditional retirement, especially from the financial planning approach. And second part of this webinar is we will discuss on the FIRE movement. Maybe some of you have already know what is FIRE movement. There is a financial independent and retire early movement. Okay, so we will discuss on these two approach, the financial, the retirement planning from the traditional or the financial planning point of view, and also the retirement plan from the FIRE movement approach. Okay, so we will start first with the what is retirement from traditional point of view. Okay, so retirement is actually when you quit from workforce. Okay, so it is the practice of leaving one's job or ceasing to work after reaching a certain age. Okay, and what we know today, the retirement concept that we know today, historically has been traced back to Chancellor von Bismarck, the leader of Germany in 1989, where he introduced a pension scheme in German. And during his tenure, the initial retirement age is 70 years old. Okay, that is where we, how the modern civilization is having a retirement age, and today's in 2024, we still adopt to the idea of retirement. Okay. And nowadays we have two types of retirement plan that is known as defined benefit. Defined benefit is actually a pension, especially if you are working with government today. Okay, maybe you have pension. Okay, you get a pension even if you. I have privilege to meet a client previously who was working currently known as Tenaga Nasional Berhad (TNB), but she worked with LLN, Lembaga Elektrik Negara. So I have met this type of person where she still have a pension because she already worked before the before LLN become Tenaga Nasional. So even currently we know that the pension is only for government, but actually there are some people that of course already old people got a pension from the corporation that is previously is a government bodies before being corporatized during 1990s. Okay, so there is defined benefit. So you know already, basically the calculation is there. You will know how when when is your last salary, how much do you will get from during your retirement. However, I'm not sure. Maybe the one who works in the government can update on this. But from my reading, from the information I've read from the media, the newly intake for the government officer now will also have to choose EPF as a source of income after retirement. So no more pension after this, especially after the new introduction of the scheme Saraan Perkhidmatan Awal, the new one. Okay. And the second types of retirement plan that we have in Malaysia is a defined contribution. That is in Malaysia, it is known as EPF scheme, Employee Provident Fund or Kumpulan Wang Simpanan Pekerja. So it is compulsory to all private sector workforce, where as an employee we contribute at least 11% from our salary, and from the employee side at least 12% for them. So effectively, at least minimum, all the private sector workers in Malaysia will get a 23% contribution into their EPF. And also nowadays we have a gig economy, gig sector. This is the informal sector of the workforce in Malaysia nowadays. So they don't have any pension no defined benefit, no defined contribution, so they have to set up their own retirement scheme for themselves. Okay, and in Malaysia, so when we talk about retirement, okay, it is different from when we discuss about how to purchase a car. It is also different when we want to discuss what to do when we want to purchase a house, because in retirement, it in a sense it differs in the sense that it takes a long time to achieve a saving goals, because we have actually two phase of in the retirement planning. First is the accumulation phase. Okay, when you are working, you have to accumulate your capital. Okay, so it will take a long time to achieve that savings goal. And also you have a distribution phase, or the post-retirement period. Okay, and when we discuss on the post-retirement period, so we have to know what is the life expectancy of us in Malaysia. Okay, because we may have a long post-retirement period, and both of this phase, the pre-retirement and the post-retirement, involve a lot of assumption and uncertainty. Okay, so for example, in this slide, you can see that Turkey have no minimum age requirement for retirement, and their life expectancy is 76 years old. And we can see our neighboring country, our neighbor Indonesia, retirement age is 58 and life expectancy is 69. And in Malaysia, we have 60 as a minimum age for statutory age for retirement, and life expectancy of 73 years old. And South Korea also 60, and however they have a longer life expectancy. But if you look further into the developed country, such as United Kingdom, 66 years old, and Norway 67, and also in US it is 67 years old. So we are actually in Malaysia, as a Malaysian, we retire younger as compared to a developed country. Even Singapore is 63 years old for the retirement age. However, we have orang kata shorter life expectancy as compared to the developed country also. Okay, for example, if you retire 60 in South Korea, you are expected to live for another 23 years old. However, in Malaysia, if you retire at 60, your life expectancy is around 15 years old only. So there is some the consideration or the calculation that we have to make post-retirement. How much do you need? Because if we live longer, for example, until 80 years old, so actually we have to prepare for 20 years of savings or retirement fund to prepare for our life post-retirement. So it has a good pro and cons, whether we should increase our retirement age. But if you read the news media lately, you can always see that there are some sense of not urgent, no, some sense of movement that most likely to increase the retirement age in Malaysia to 65, because they always stated that as a Malaysian, we won't have enough savings to retire. You need to work more in order to accumulate savings and whatnot. Okay, so this is the first uncertainty aspect, the assumption aspect that you have to make in order to do retirement planning. That is how long you are expected to live. Of course, it is something that we cannot be certain at all. We know that we will face death one time, but at what age, nobody will knows. Okay, so in Malaysia, EPF is the main retirement savings for private sector and maybe for the future public sector also. So if you can see here, we have three actually. The core is the EPF. So it is a retirement fund created as a federal statutory body. So everybody here in Malaysia, for private sector, you have to open an EPF account and to contribute into your account every month. Not only you, but also your employer. So there is the core of your retirement fund will be put in the EPF. Okay, so your EPF will be accumulated, okay, inside. And also we have been introduced to the another retirement scheme in Malaysia. There is a private retirement scheme or PRS. It is not a statutory body, but it is it's a platform for anybody who want to add their savings voluntarily for long-term savings and investment scheme that is to design to help you to save more for your retirement. Okay, so you have EPF, that is your core, and you can top up with your PRS, or you can add into your retirement fund with other investments, such as you invest in the stock market, you invest in the unit trust, and etc. Okay, so to encourage Malaysian to have more, to save more for retirement, from the tax really from the internal revenue board, our LHDN, Inland Revenue Board, I'm sorry, they provided us a tax relief for both PRS and EPF. Okay, so if you first you have uh, maximum 4,000 for EPF, but if you open another PRS account and you voluntarily you top up your EPF, so there will be additional tax relief for you. So there's the how the government would like to encourage us to save more for retirement. Okay, so if you don't have EPF, if you don't have PRS, for example, you are independent contractor, you are involved in the gig economy, so actually you have to have your own retirement plan, because of course not all of Malaysian is working in the private sector. Some of us is working as a businessman, having their own business. So don't forget to set aside, to allocate some from your revenue, some from your salary into your retirement fund. Okay, so now we will look into the strategies that are available in the traditional retirement planning or the financial planning approach in retirement planning. So the first step is actually for you to ask yourself, do you want to have a generational wealth or not? You want to create a generational wealth or not? That is, you want to leave a legacy or you doesn't want to leave any legacy? Okay, so that is the first step to ask yourself. And bear in mind that everybody is unique. Okay, nobody have the same retirement plan. Although you may have the same salary with your, for example, your colleague, your partner, but you may have different needs. So you may have different financial objective. So one of the objective is, do you want to create a generational wealth or not? Okay. Generational wealth is actually is you want to leave some legacy to your children, or do you want to contribute more to society by giving donation, charitable purpose after your death. And also by having generational wealth, your objective to create generational wealth. So actually you can live off your investment, okay, so that your fund can generate income in perpetual. Okay, so is the second one. It is also known as a capital preservation. The goal is to have a self-sustained retirement portfolio growth so that the capital is preserved even after all retirement expenses. And the other option is capital liquidation approach. That is where you have to accept, you have to know that the fund, your retirement fund, will run out of money sooner or later. Okay, so the goal of the fund is to fund the retirement throughout the life, but not to have any assets left as estate planning, because using a will or private trust. Okay, so you can see from the two charts here, the different. For example, you retire at 60 years old. So for the first, the capital liquidation method, you will find that maybe after 15 years, after 18 years, you will run out of money. However, with a capital preservation method, you will still have the money even after your death. So it is up to you whether you want to create generational wealth or not, or you think it's okay. My obligation to all our child is just to give them education. So by having a good education, they can find their own works. They can have their own business. So it is up to them to create their own wealth. Okay, it is up to you. It is you can. It is not you are not a bad parent if you doesn't want to create a generational wealth. It's okay. It is up to you. It is your money. It is your capital. So it is so whether you want to leave it to your child or not, it is really up to you. Nobody can force you to leave a legacy to your children. Okay, so that is the idea, the basic idea of retirement, whether do you want to leave a legacy or not. And from I quote Warren Buffett, still alive until today. Actually, in the real risk in investment or in life, most people when we talk about risk, they will state that the risk is volatility. When your value of investment going down, but actually the real risk in life is if you outlive your retirement fund. That is actually your real risk in life. Okay, you just think you live until 90 years old, but your retirement fund uh, has run out at the age of 75. So you have another 15 years old where you don't have enough money to sustain yourself, and you have to get assistance from your child, uh, and you have to sell everything that you have because you outlive your retirement fund. This is something that is scary. There's the real risk that you have to really take into consideration, because if you run out the money now, for example, you are 30 years old, you run out your savings now, it's okay. You can do second work, you can do second job, you can hustle to do any jobs. But in the age of 80, in the age of 70, it is not suit for us anymore to have a second job, or even we still have the main job to sustain our life post retirement. Okay, so how do you want to achieve, whether capital liquidation or the capital preservation? So basically there are two approach that you can do in order for you to know what is the number for your savings that you needed to reach. Okay. So first, how much income you need for post-retirement? So first is the income growth approach, and the second is the expenses approach. Okay, so I will explain briefly what is the income growth approach. Okay, so the income growth approach is actually when, for example, I have client 40 years old, she want to retire at 60. So basically, she's still far from retirement age. She still have 20 years from retirement age. Okay, so that is the thing that you have to understand. Income growth approach, that you still have a lot of time to accumulate your wealth. Okay, however, you have to estimate the growth of your salary. This is something that is hard to do. You have to assume whether how much your income is growth every year. So but it is something that you have to do. In order, if you want to use an income growth approach, that is, you need to assume, you have to make assumption how much income annually you can grow until the age of 60. Okay. And the second approach is expenses approach, where it can be done when it is near your retirement age. However, it is not suitable for those who still, for example, 20 years is still far from retirement age. Okay, because nowadays your salary may be still low, but towards your retirement age, you maybe become a CEO of the company. You maybe become your salary maybe nowadays now is 8,000. Maybe you triple your salary, reaching your retirement age. Okay. However, the expenses approach is more realistic. as compared to income growth approach, because when you do it nearer your retirement age, you already know what is your healthcare cost. One of the biggest costs are post-retirement. If you're still young, 30, 35 years old, maybe you still don't have to have medication that you have to spend every month. But when you are 55, you are 59, maybe you already know what your medication expenses on that time. So there is something that we have to balance it out. But again, when we are doing retirement planning, it is all about assumption. You cannot expect precision in calculate the retirement planning. However, estimation, what all you can do is estimation. So at least to have numbers that can become your target, and from that numbers that become your target, you can draw a plan how to reach the target. Okay. So we will look for the first approach. That's the income growth approach. First, you have to look your current income, your gross income. Okay, so you have to estimate your salary growth. Of course, it is very hard. What is the best approach? It is very, in practice, it's very hard to do. And yes, to retirement. Okay, how many years for your retirement, and also your replacement target percentage. Okay, so this is my illustration. Okay, for example, your current income is 40,000 annually. So I am using a very conservative salary growth, that is 2% only per year. And years to retirement is 20 years. So if we use 60 as a retirement age, so currently still 40 years old, so you have another 20 years to retire. And we have replacement target. Usually we use around 2/3 from the last salary. So I use here is 70%. So after the calculation is made, your desired income post-retirement is 42,000 ringgit. Okay, so now you already know. This is assumption. So if you use a bigger gross salary growth rate, so you will have a bigger number. And if you use a higher replacement target percentage, you will also have a bigger desired income post-retirement. This is for the purpose of tonight discussion only. Okay, and for the second approach, the expenses approach, you have to look into your current expenses. And for the purpose of illustration, I use a savings rate because after retirement, you don't need to save money anymore. And also next is your debt service amount. So because it is assumed after your retirement, you should already settle all your debt. So you don't have to pay the debt anymore after retirement. And what you got here is lifestyle expenses, the balance. So this is my example. So for example, currently you take home 60,000 annually. Okay, your minus 10% your savings per year, so there is minus 6,000, and also minus all your debt, another 18,000. So the balance will be used as your desired income post-retirement. So in this illustration, the desired income post-retirement is 36,000. Of course, this is not the only calculation you can make, but I just give you some ideas what to subtract from the expenses, because of course we have a very different expenses during your working days, and also your pre-retirement days, and also the post-retirement. For example, you are no longer have to commute to work, so you don't have actually a high transportation cost, for example. However, having said that, you also have to remember when you are 60 years old, you have a higher medical expenses, for example. And also if you have a child, you maybe have to incur the saving that you have to allocate some of your savings for your weddings, for your children's wedding, and other things. Okay. So this easier part. Okay, you got the numbers, 40,000 and also the 36,000. We come to the tougher part of retirement planning. there is how much do you need? Okay, how much do you need in order to get 42,000 to get 36,000? So how much actually do you need? The capital do you need? The savings that you need? Okay. So first, okay, for this purpose, I use 42,000 as the desired income. So the objective here, the first calculation here is for capital liquidation. So you don't have intention to create generational wealth. So now we know how much the income needed. Okay. So the next assumption that you have to make here is your post-retirement return. Okay. What is your return on investment post-retirement? And also you have to estimate the inflation rate and also how long you need the money, the period of retirement. Okay, so from there, I choose 40,000 annually from the income approach, and 4% of return on investment post-retirement, and I use 3% inflation rate, and the period of retirement is 15 years. So from this calculation, we got around 600,000. I just make it a round number. Okay. So the target is 600,000, and this from this amount of capital, you expect this amount is expected to last until 15 years post retirement. Okay, so this is something again assumption that you have to think properly, because why 4%? Why not 5? Why not 5%? Why not 6%? Why not 3%, for example? And also for inflation, I have here some data from DOSM, that is Department of Statistics of Malaysia, on our inflation rate. Of course, usually we use 3%, but in real life, for example, in 27, the inflation rate is 3.8%. And in 2018, the inflation is actually below 1%, it's 0.97%. 2019, we have 0.66%. And 2020, we have negative rate of inflation. There is negative 1.1. 2021, 2.48, and 2022, 3.38, and 2023 is 2.49%. So if you look to the inflation rate that officially published in the website of Department of Statistics, so you will never find 3% there. So you have again that you have to estimate some numbers, because in the traditional retirement planning, from the financial planning point of view, we actually has already factor in the inflation factor into the calculation. Okay. So, but in reality, in some year you have a very high inflation rate, and in other year you have very low inflation rate. Okay, that is the reality. So usually I use 3% as the inflation rate to factor in the inflation factor in the calculation. Okay, this is the next calculation, that is for those who want to preserve the capital to create a generational wealth. So the same input is needed. What is your income needed? The post-retirement return, the inflation period. However, you have a different numbers because you want to create generational wealth. So your retirement savings target is around 4.3 million. Okay. Again, 4.3 million is based on 4% of post-retirement return and 3% of inflation. If you have higher post-retirement return or lower inflation rate of inflation that you use in your calculation, so your retirement savings target for generational wealth will be much lower. So it is all about assumption. Okay. However, the most gruesome part of the retirement planning is how to make sure you don't have any shortfall during your retirement. That is, the shortfall is the risk or danger of not meeting your income post-retirement, or in the Warren Buffett words, when you outlive your retirement fund. Okay, I'm not delving into the details here, but I just give you the concept, the general approach how to calculate. So first, you know already how to calculate the retirement savings target. Now you have to estimate your retirement asset growth, and also you have to find the differences between the A and also the B lah, the retirement savings target and also your retirement asset growth. This is just a simple illustration. For example, you know your savings target is 600,000, and when you estimate your retirement asset growth, you have 400,000. So the shortfall is 200,000. So this is something that you have to aware, not to have a shortfall during your retirement age. Okay. Okay, so there's about the traditional retirement planning before we got into the FIRE discussion, financial independent, and really early retire early. Okay. Okay. So retire early means you quit from your workforce much earlier from statutory retirement age. Okay. The financial independence retire early or FIRE is a lifestyle movement that prioritize extreme savings and investing in order to retire earlier than traditional methods might allow. The traditional methods referring to the financial planning methods. Okay, so the FIRE investors aim to achieve financial freedom so they can choose how to spend their time. So they have a different point of view. Maybe you emphasize you think time is more valuable. Okay, so you doesn't want to tie to into your corporate life until the age of 60. You want to have holiday for 6 months, for example. And the concept has been popularized by Vicky Robin and Joe Dominguez in 1982 best-selling book, Your Money or Your Life. Okay. So we will look more on this FIRE movement here now. Okay. Now I put more data on life expectancy in Malaysia. Okay, this also from Department of Statistics of Malaysia. So male Indian have the lowest life expectancy. There is you are expected to live until your age of 67.6, and the highest life expectancy in Malaysia is Chinese female, that is 80 years old. But on average, if we combine all this data, we have around 75. The average is 75 years old. So you can look here, what race, what is your gender, so you can have a clear life expectancy, and of course it is only expectancy. You may have lived longer, more than 76 years old. For me, as I am a male Malay, the expected life is 71 years old. My father-in-law passed away 69 years old. My father passed away at the age of 53 years old. My mother passed away at the age of 63 years old. So they are not even live until 76 and until 71 years old. So it will be very different scenario. But however, we have to make some assumption, some estimation, how long we will live, okay, in order to discuss retirement planning. Okay, so FIRE movement differs from what we have been discussed previously in terms of frugality, that you are kena jadi, in Malay term, jadi very kedekut. You must have a very high rate of savings, okay, and your priority is investment. You need to focus more, mainly your income is for investment purposes. So we will look into the calculation. Okay, before that, we will look what is the key features of the FIRE movement. Okay, when we talk about the retire early, so basically the movement said that to determine the amount of savings needed for the retirement, so your annual desired income have to multiply by 25 times. And how much should you withdraw from for your post-retirement is 4% from capital annually. Okay, then, and lastly, you may still need to invest exactly like pre-retirement. Okay, if from the traditional or from the financial planning point of view, you have to be aggressive investor pre-retirement, and when you reach your retirement age, you are already in the post retirement. So you have to invest more conservative. There is, you should expect only for the number, the return of investment that you expected for investment is only around But however, in the FIRE movement, you may still need to invest aggressively, same as you invest pre-retirement. Okay, so if you need 40,000 annually, you need to become a millionaire. Okay, how? So the retirement capital needed is actually determined from your desired income post-retirement. So I have choose for you the 40,000 here. So you have to choose your rate of return. Okay, so for example, 40,000 annually and 4% per annum. Okay, so how to know your numbers? Actually, 40,000 you divide by your rate of return. So your capital needed to retire early is 1 million. So it is from FIRE movement approach. So still 40,000 annually, how is actually around, if you calculate the numbers, the 40,000 annually divide by 12, so your salary or your cash flow for your during your retirement age is around 3,333 ringgit. Okay. Even so, you still need to become a millionaire. Your savings amount, your retirement fund must have at least 1 million ringgit. Okay. So it is very simple. They very simple approach. You don't have to assume much things. However, you have to take note that these numbers is not take into consideration the inflation rate, for example. Okay, so what we know so far, the challenges in FIRE movement here. So I have list the capital liquidation method, the capital intake method, and also the FIRE. So what we know so far is, so the desired income is almost the same, 40,000 and also 40,000 per annum. And the retirement age is 60,000, I'm sorry, 60 years old. The capital intake also 60 years old, okay? The period of retirement is 15 years. For capital intake is virtual. Return post-retirement, 4%. Capital intake, 4%. And total savings needed is 600,000. The capital intake is 4.3 million. And FIRE is around 1 million. So now you got the picture. At least how much you need. And if you want to retire early, how much do you need? And if you want to save create some legacy for your children, how much do you need? At least for tonight, based on my given assumption here. Okay. So where are you now and where do you want to go first? It is also a hypothetical person. I am 30 years old and I plan to retire at 40. I make 80,000 a year and save 10% of my income annually for retirement. I have already saved 100,000 for retirement. My desired FIRE annual income is 40,000. This for illustration purposes. Okay. So how to achieve this FIRE savings goal? So the savings goal is 1 million. I have already shown you how to get the number, how I reach the number of 1 million. So the initial investment here is 100,000. And years to grow is 10 years because now 30 years old and he want to retire at the age of 40. So he have 10 years to grow the capital. And the expected return is at percent per annum. Okay, if this is the situation, actually the person need to save around 4,500 ringgit monthly or 54,000 annually or 67.6% from the income. Okay, this is what is meant by you have to become very frugal in order to retire early. Okay, can you live with 20 around 33% only from your income to live for 10 years? It is up to you to decide. Okay, so now we will compare the FIRE movement, the capital intake, the capital liquidation method. So we will discuss first the FIRE movement now. So desired income 40,000, retirement age 40, period of retirement. So I use the life expectancy of 75 years old. So you have to remember, if you choose to retire early, so you have another, if you retire at 40, you have to assume you have another 35 years old to live. So you have another 35 years old that you have no regular income, you have no salary. Okay. And return post-retirement, it depends actually. And total savings needed is 1 million. So the current age is 30, your annual income is 80,000. Period to retirement is 10 years from now. Your return pre-retirement is 8%. Your initial capital is 100,000. Monthly saving 4,511 ringgit, and annual savings 54,126, and your savings rate is 67.6%. That left you the balance of 25,874. So if you can calculate, you divide by 12. So actually you live with you live for 10 years with 2,156 ringgit only. So can you really live with that amount of money for the next 10 years? So it is up to for you to decide. And we compare with capital intact. Okay, so I go to here, the same annual income, I put the same income, 80,000. So period to retirement is 30 years old, because still 40 years. Now return pre-retirement is 8%. I use return pre-retirement is a bit high, 8%. Initial capital is 100,000. So your monthly saving is 2,423. Your annual saving is 29,000. Your savings rate is 36.3%, and your balance is 50,000 ringgit or 51,000 ringgit to live for a year. And as you compare with capital liquidation, okay, same annual income, period to retirement is 30 years old, return to retirement age, all the same. The difference is you can even start your initial capital is 0, but you cannot calculate from 0. So I put here 10 ringgit. So the monthly saving is 427. Your annual saving is 5,120 for annual savings, and your savings rate is 6%, way below the 10% recommended by in financial planning. And your balance to spend is 74,880. So this is how much you need to achieve the 600,000 in 30 years 30 years time. Okay, so you can compare all this calculation with certain assumptions. So which one is more realistic from your point of view, whether capital liquidation, capital intact, or the fire movement approach? Okay. Okay, so the challenge number one is it is unbalanced trade-off. Okay, can you live with 25,000 annually or around 2,000 monthly? Okay, can you save up to 70% from your annual income? It's a very high rate of saving. And can you defer other needs other than savings and retirement? So you have to, maybe you don't have, you won't take any insurance or takaful. You may don't have, you have you pick car by cash, old car. You may not buy a house, you may only rent a house, and your lifestyle is very different from your colleague because your main focus is solely on investing. So this is unbalanced trade-off. Okay, so if you cannot do this, because as has been stated earlier, the difference between the FIRE movement and the traditional approach is the extreme frugality. So you have a very unbalanced lifestyle and a very different lifestyle as compared to your colleague. Okay, that's the challenge number one. Okay, do you really want to retire early? So that is the price that you have to pay. Okay, the challenge number two is you have to create a multiple source of income, or you have to be a high income earner. Okay. So we can do some sort of reverse calculation or the reverse engineering here. So basically, you have to determine first how much you need monthly or yearly for your basic living cost, and you times 2 or 3 from that amount. So for example, you have estimate you need 1,000 ringgit for your basic living cost monthly. So you can times by 2, or you can times by 3. So actually, you, in order for you to retire early, you have to have a monthly income. And if you have 10,000 of basic living cost, you have to around 20 to 30,000 now, your salary. So of course, if you already achieve that level of salaries, congratulations. And if you still don't reach that level of income, so you may have to create multiple source of income, or you may have to find another job that can give you a higher salary. This is based on the 10,000 per month basic living income. And with this type, we do some reverse calculation, reverse financial engineering here. So you can save between 50 to 70% from your income in order for you to retire early. So this is challenge number 2. Maybe some of you can or already have this type of income. Maybe some of you still find it is very difficult to get this type of income. Okay. And of course, you have to take risk forever. Okay, because by using a Malaysian life expectancy is 74.8 years or 75 years. So basically, if you retire at 35, you have 40 years post-retirement life. If you retire at 40, you have 35 years of post-retirement life. But if you retire at 65, you have to take only about 10 years of post-retirement life. That's why we can see all the some sort of framing in our mainstream media to increase our retirement age from 60 to 65, because based on the life expectancy, you should only worry for 10 years of post-retirement life. Okay, so I will discuss here why we use 4%, not 6%, not 8%, not 10%. Okay, so from the chart that have been shared earlier, so you have two phases. There is the first, this accumulation phase or the growth phase. There is the asset allocation should be heavy on equities, and the next phase is the distribution phase. That is the asset allocation should be heavy on the fixed income, such as bond and sukuk, for example. Okay, so there is the two basic phase that you have to know: pre-retirement and also post-retirement. However, for FIRE movement, it won't be like this. This is a traditional approach. You heavy on equities pre-retirement, and you heavy on bond and sukuk or fixed income after retirement. However, for FIRE movement to retire early, you may have to your asset allocation is different. You may have to heavy on equities on both phase. There is during the accumulation phase and also this distribution phase, you have to put much money into equities. Okay. And this is what I have here, the data that I will show. I want to share with you. So this is some asset class that I have prepared. I have tracked. Okay, first we look into the world stocks here. There's when you invest in the world market. So for the for the past 5 years, the return is 12.6%. If you invest in US stocks, the return is higher. That is 16.39%. If you invest for the past 5 years into our blue chip, that's the index, you got negative return. Okay, this is annualized return. Yeah, it is not a it is not a total return. It's annualized return. And if you put your capital in medium and small cap stocks or funds, you have your expectation return is 12.8%. And if you put your capital in gold, you have your return is 10%. Okay, I use gold ETF here for the purpose of calculating the return. Okay, and the next to the return numbers actually is the standard deviation numbers. So in order for you to have this type of return, 12%, 16%, so you can see the standard deviation number or the risk that you have to take. There is the numbers. There is the lowest is 14.17 and the highest is 18.82%. So that's why post-retirement, the traditional approach, we advise client to not to be too really heavy on equities, because the risk is there. The risk is much higher. Of course, the return is higher, but it is okay for over long term. But when it comes to the distribution phase and you need the money now, because when you accumulate, you need the money later. Maybe you need the money in 20 years time from now. So you can afford to lose some money. For example, this is a standard deviation. If you look from the drawdown perspective, if you look into the numbers, so you have to bear up to 30%, 30 to 40% drawdown if you invest in US stocks, for example, and also if you invest into the medium to small cap stocks. So it is a very high risk, okay? And when you have retire, so that's why we use 4% number, because this is the recent yield for our in the bond market, 3.85%. For SB, for Bumiputra here, you have 4.07%. However, you have to understand for ASB, we have limit until 300,000, and even you only want to retire with 4,000 ringgit, you still need to have 600,000. So you still to invest in other places. And if you put your money in the cash or the money market, this is from fixed deposit is 2.47%. So this is a distribution fee. So this is what we call when we have this number, so you can do your asset allocation better. So if you want to focus, so that's why when during the accumulation to the growth phase, yes, you can invest heavily, you can allocate your asset heavily in the equities. So if you can, you can have a gut to look into the volatility of the market, so you can achieve this type of return over long term. This is a 5 years return. Of course, when you need the money, you cannot afford anymore, because if for example now, the Israel and Iran already having war. So we are already seeing our market, for example, especially the blue chip, the index, our KLCI is really taking a good having a good return. However, when you want to reach 170,000, 700 points, Israel-Iran war happens and the market dropped for this week. So there is the volatility that that you have to know when you are heavy on equities. If you are still accumulate, it's okay, but if you are in the distribution phase, then it is not really okay. But again, if you are fire movement, you have to still to invest heavily in the equities market even after you retire. Okay, that's the justification. So of course, I would like to emphasize more on this, because sometimes when you meet with the salespeople who promote some product, they don't really take this into consideration. They only prefer to show you the return on investment, the past return. However, who do you meet that can show you the standard deviation? Who will state it to you if you invest in US stock, if you invest in medium to small cap stocks, you have to face drawdown up to 30 to the range is 30 to 40%. Most of the salesperson will only focus, yeah, you can put return here, but they never shows or reluctantly to show the risk that you have to take together in order to get such return. That's why when I read in the social media, the post, especially from the younger generation, when their investment drop 2%, 3%, they already not really comfortable. So 2 to 3% actually is very normal in the equities market. If you cannot bear the volatility for 2-3%, so how you can bear how you want to bear to the price drop until 30%, until 40%, because that is the real thing that happens in the market now. Okay. So, and the challenge number 4, before I answer your questions, okay, because I have 1 hour to present and another 3 minutes to answer for Q&A session. So for the FIRE movement, for one who wants to retire early, actually you also need to develop a marketable skills, because in order to cushion, especially the inflation when you face the higher inflation period. Okay, as I show you previously, our inflation is also up and down. It is not static 3% every year. It is up and down. If you retire during the inflation rate is low, it's okay. But if you retire during the inflationary period, so you need to have marketable skills that where you can become independent contractor who earns wage on per job or per task basis, typically for short-term work. Okay, there is become a freelancer where you have the freedom to work from home, and it is from a non-traditional workspace. You have a flexible work schedule and a better work-life balance. This something that you have to think now, because if you when we retire, and unfortunately we retire during high inflationary rate, so you better have skills, or you better have some other income that can support you during that high inflation period, because it is something real. For example, last year and last 2 years, we can see our crude palm oil price is very high. Of course, it is a good thing for those who involved in the crude palm oil derivative market, FCPO. However, for users who buy palm oil to cook, so they have to pay very high price for the cooking oil. Some also the same with the rice price, harga beras, which happened to become very high during last year. Okay, and also the egg price. Okay, before the inflationary tone down this year. So there is something that you have to think. What is your marketable skills that you can use, that you can do some freelance work after your retirement? But of course, if you have enough or the big retirement fund, so you don't have to develop the skill because you have enough in your retirement fund. It is I'm talking here the challenge to the FIRE movement proponent. Okay, that's all my presentation. So now we enter into the Q&A session. Okay.
Thank you so much, Pakdi, for sharing with us about retirement planning. Should we retire early, like fire, or should we retire late, right? So which one should use? So if any questions are asked our speaker today, please write your question in the Q&A box, and then we will address them accordingly. All right? Don't write them in the chat box, write them at the Q&A box. So the first question I see on my screen is from Kennedy. So for post-retirement income using capital preservation approach, what are possible investment portfolios like to get consistent returns of 6%?
Okay. The question is 924. Okay, that's where the last slide is about the return of the assets. Okay, the class asset previously. So can I show again the slide? Yeah?
Sure, please go ahead.
Okay, so how to get a 6% your portfolio return? Okay. Okay, so you have to look here back. Okay. So this is a type of class asset. This is not the product. Basically, yeah, of course, some based on product, but actually it's more on the class asset. Okay. First, you can see here the highest return. The highest return is the US stocks, but it comes with the high volatility. The standard deviation is 18%. Okay. So if you invest in the US stocks over long time, you may expect to get higher return. However, over short term of period, you may have to face the very high volatility. That is 18.82% from standard deviation. Okay, so if you are really aggressive in your risk profile, so you can close your eyes, just buy US stock, especially ETF. You can buy ETF in Bursa for US, or you can buy ETF, any ETF that invest in US stocks, for example. So you will outpace the inflation. You will get even more than 6%. Okay. However, because most of us is not Warren Buffett, where we cannot stomach the volatility, we cannot see the price drop. So you have to spread your portfolio. You have to do a proper asset allocation, we call it. So you have to mix your equities with fixed income. For example, in the easy allocation is you have to have the allocation of equities, and also you have to have allocation in bond. So if you are aggressive investor, so the allocation would be around 70, 80 to 90% in equities, and only 10, 20 to 30% in the fixed incomes, such as in a bond here, maybe I refer it to the bond fund, unit trust, because we as a retail, we may not suitable to buy bond directly unless you have multi-million ringgit in your account. But you have a few hundred ringgit, few 100,000, so it is better for you to buy bond fund. So there is the allocation for aggressive investor. So when we talk about aggressive investors, so it is a 7, 8, 9, 10% return. So if you are target to 6%, basically you can lower it by having around 60 to 70%. 60% of equities and 40% of bonds. So you can become a moderate investor. So moderate investor is between 50-50 of equities and fixed income, or 60% of equities and 40% of fixed income. However, the trickier part is which equities that you want to invest. You want to invest in stocks. Now, because we are Malaysian, when our ringgit is weaker, so you have a very good return in US for the US market. However, nowadays, our ringgit is very strong as compared to the greenback. So now, your return in US market actually negative. Although the return, if you see from the dollar return, is positive, because the issue of our ringgit from 4.8 or 4.9, sekarang berapa? 4.1 so it is very much strengthened. So it is not even wise for you to put everything in US, although it is not wrong, but it is something that you have to take into consideration. So you have to mix with Malaysian or to the local stocks also, and even you have to consider maybe gold or even REITs in your portfolio. So it is something, the idea is to do as allocation 60-40, but the trickier part is in the 60% of equities, which sector or which geographical sector that you want to focus. Whether you want to focus on the world stocks, US stocks, the blue chip, the medium, or you want to, maybe I'm not started here in China, because for the past 5 years, the China market is also like our Malaysian blue chip, not really good. However, in the last week, the China stock really rally very well, and we have ATF China in our local in our Bursa Malaysia to buy. Okay. So you just try to calculate, you can develop a 60-40 investment portfolio for your retirement. Okay, for other question?
Yeah, thanks, Pakdi. So the next question is by Sam Nair. Now, during the distribution phase post-retirement, is it okay that we stay invested in equities? So there's the question. So why should we choose bond during the distribution phase?
Okay, thank you. Yes, you can, it is okay. Actually, it is okay for you to hold your public listed shares after retirement. Especially if you are still feel that you can become a aggressive investor. So it is not a wrong answer. It is not a wrong idea for you to still invest in equities. However, the discipline or the practice here as a financial planner, because I am a financial planner here. So basically, our default advice when reaching retirement age is to be heavy on fixed income side, because now you don't have much time to accumulate, or you're in a period of to take to reap what you saw during your hard work in your earlier age, in your younger age. So now you should enjoy your capital. Okay, so you want to use the capital, your profit, your capital for other things, not only for investment. Because we are not, our life is not only for investment. We also need to go. We have other needs. But if you think that you want to hold to your public listed company, it's also okay. But bear in mind, of course, Bursa usually, if you follow the social media, the list of companies that give a good dividend yield. We have a very good company. I doesn't want to state it which company that, but you can find it in the recent newspaper article that give you 8%. Okay, 8% dividend yield. So it is a very high. But you have to bear in mind you also have to know how to fundamentally choose the right stock, because I have stocks, not now lah, but I have a watch list of stocks where in the past years, this company is very good in giving out a dividend. However, due to economic changes, now they are unable to give dividend for certain period of time. And after they do some changes in their business strategy, now they give the dividend back to the shareholders. So there is the risk that you have to understand, and unless you have a very really good skills in evaluating companies for you to make sure that the dividend is consistent throughout your retirement years, it is okay. Because as compared to the bond, equities, the dividend payout is really depends on the operating income of the company. And the income of the companies is having its up and down. Okay, because you are partners of the, you are the shareholders, you are the owner of the company. So it really depends on the performance of the business. However, in the bond, it is different because the capital is protected. Not guaranteed, you have to understand. The capital is protected, where after the maturity period, you will get back all your capital if there's not any funny things happen. And at the same time, for example, you buy a bond or sukuk for 7 years note. So during the 7 years note, the sukuk holder will pay you, for example, how much the yield, the coupon. So the coupon is actually a dividend, but it is from bond and sukuk. So for example, the yield is 7%. So throughout the 7 years of you holding the bond, you will get 7% from your capital, and after 7 years, you will get your capital back. So there is the difference between equities and bond and sukuk. So that's why, because the phase is different, so you have to use a different type of asset in order for you to have enough enough cash flow for your retirement. So having said that, because actually, if as a financial planner, the client actually is not really it's not really have a right skill to choose their own stocks. But if you can have your own skill in picking stocks, this is very okay, and it is not a wrong move for you to hold to your public listed company.
So when you join our webinar regularly, you should be more competent to do direct investing by picking your own stock.
Yeah.
Yeah. Thanks everybody for joining. All right. So the next question is by Robert. Why is the suggestions by the media always that the minimum EPF saving for Malaysian at around 240,000 ringgit, but your minimum is at least 600 ringgit, 600,000 ringgit for the EPF savings. So this is so far different and so far beyond that I can achieve, right? So Robert is at post-retirement now and would like to use local equities for his retirement. Do you have any strategies that can use so that he can achieve this return?
Okay, first I want to comment on the APF calculation. So the APF calculation actually being calculated since 2019, 240 ringgit. So they have certain assumption. Then the assumption is you would use 1,000 ringgit only per month for 20 years. That's why they came out with 240 ringgit calculation. My assumption is you would like to have 40,000 annually for 15 years with and taking into consideration inflation factor. So why the number is different. EPF used 240 and mine is 600,000, around that numbers. Okay,
So you say they
so
assume 2,000 ringgit per month.
1,000 per month
1,000 ringgit per month. Yeah.
for 20 years. So that's the
Okay.
assumption.
That's
Why they
interesting.
use that? Why they use that assumption? You have to ask EPF lah.
I'm not sure if I can survive 1,000 ringgit on a
Of
week.
course, 2019 and now 2024. There is inflation there for 5 years already.
So it's better to use a benchmark, lah, say 600,000, right?
Yeah, because I have used some this very basic assumption: 3% inflation, 4% return after retirement for 15 years. Okay, so that's the comment on the EPF calculation. So on the how do you want to live? Okay, basically, if you have a shortfall, basically you have a shortfall. So that's why when you have a shortfall, there is something that you have to think first. Can you retire later? I mean, maybe I'm not sure your age now. Our statutory retirement age is, our minimum retirement age is 60. So maybe you have to work until 65, or you still need to work, you still to have a second job, for example. And also, it is a very common in if you read in US based personal finance book that they not migrate, they change they have concept of retirement house. They have cities that which one the best cities to live for retirement. Kalau in Malay culture, kita gunakan term balik kampung. So now you may live in KL or Lembah Kelang, Shah Alam, Kajang, but your kampung dekat maybe Gua Musang, dekat Pasir Mas, Kelantan, or maybe Sik Kedah. So the very much different in terms of the cost of living. So instead you live in the city, so you decide to change your residence into the suburb area. Okay, maybe something, I'm not sure the Malaysia still don't have this concept of retirement house or even we don't have data which city, which place is suitable for retirement purposes. Whether in KL, Selangor, even in Selangor, you also have a very good place such as Sabak Berenam, Tanjung Karang. It is not very far from KL, but it's a very kampung style environment. Maybe for Malay, it's okay for you to live in that area. Even sarap for breakfast still cheap. Even I'm happy to live there if I have to. Now I live in Kajang, for example. So if I have option to live, maybe I can choose maybe Kuala Selangor, Sabak Berenam, Sungai Besar, that all those are northern part of Selangor. But again, of course, it is very personalized. First, work, you have to think of can you retire at later age, or would you like to live another parts of Malaysia? And thirdly, of course, how to overcome the shortfall is to change your lifestyle. But it is something that we, even as a financial planner, actually we don't really encourage for you to change lifestyle. But that if that is the case, that you have a very acute shortfall scenario, yes, you have to downgrade your uh, lifestyle from maybe nowadays you spend 8,000, 7,000, maybe you have to spend half from that amount. Okay.
Thanks, Pakdi, for addressing the question. The next question is about MIDS. Okay, just now you mentioned about MIDS, right? I think it stands for
Yes.
mid and small cap index. So why is the mid cap stocks have a much lower standard deviation than the blue chip?
The calculation, I took the number. I don't calculate myself, but the numbers you can find from the fact sheet, FTSE Russell of KLCI. You can go to the FTSE Russell. Our KLCI index benchmark is using FTSE, so you can search Google FTSE FVM KLCI. So you can see many fact sheet there with regard to our index. So you can see for the 5 years number. So how they basically I just use that number. I don't calculate the numbers for myself. Okay.
All right. So the next question is by Mahalingam. He said that I'm 50 years old. I have 1 million in EPF with 300,000 for emergency funds. I have no debt. So can I retire at the age of 50? What is your view?
So the answer, it depends on how much do you want for your income post-retirement. Okay. So I have show you if you can live with 40,000 ringgit post-retirement. So you can retire already. If you have skills to choose individual stocks that can give you a better dividend, of course you also can retire now, but it depends on how much do you want post-retirement. That's the first, because it have two numbers that you have to know. First, how much do you want post-retirement annually? And secondly, how much capital? Now you mentioned only capital, but you didn't mention the cash flow that you need post-retirement. Okay.
Yeah, I think if you live a simpler lifestyle, then
Yeah.
you can retire earlier. Okay. If you live a more sophisticated lifestyle, then maybe you have
million is not
to
enough.
accumulate more. All right. So let's do this one last question from Gunnar. So this question, I think most Malaysians also have it, right? So what about we save in EPF compared to invest in bonds and ASB? Is it better to leave our savings in EPF or invest it elsewhere post-retirement?
Okay. So reality, we actually the core of our retirement fund is in EPF. Okay. So an EPF cap how much we can contribute annually into EPF. So it is not like a savings account, normal savings account where you can put 1 million, put 2 million easily, and next day you can withdraw the savings. EPF, if I'm not mistaken, the limit is 60,000 per month. Per year, or even 100,000. I don't remember the exact numbers. You can look into the EPF website how much the maximum contribution that you can make, you put into EPF. We have the EPF set the limit. So that's why even though you have millions, for example, you cannot put everything into EPF. The contribution is being capped at certain numbers. So that's why you have to combine EPF, one certain allocation, and another allocation is another fixed income. For retirement, for retirement purpose, there is a fixed income, there is the bond or sukuk or the bond fund unit trust, for example. So there is how it is, the regulation. You just cannot simply put 1 million into EPF tomorrow. You have to follow the limit allowed by them.
All right. So that's all the time we have for Q&A with Pakdi today. So thank you so much, everybody, for participating in this session with Pakdi. And thank you so much, Pakdi, for sharing with us the various retirement schemes that we have available in Malaysia and what are the strategies you should go about doing our retirement. So thank you so much, Pakdi, for sharing with us this idea.